to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Here's what we're watching this hour. We're going to bring you big takeaways from bank earnings as JPMorgan, Goldman Sachs, Citi, and more report. Plus, China retaliating against President Trump's latest tariff threats. We'll have details. And we'll hone in on Johnson & Johnson as the pharma giant raises guidance and announces a spinoff. All that and more coming up on Market Catalyst. But first, we got to get you caught up on what's going on in stocks right now. And the shorter answer is we're seeing the sell-off resume. What we're looking at here is a 3-day chart of the Dow. Now, remember, of course, we started to see the pullback occurring on Friday in the major averages, and that's as President Trump sort of ratcheted up the rhetoric against China in response to China imposing some more restrictions on the export of rare earth minerals. Then we had a little bit of a rebound on Monday after he offered some reassuring words over the weekend. But now, with China coming out with some more measures, we see stocks going back down. So volatility over the past few days, and all of it equaling a 1.4% drop in the Dow over that period. For the S&P 500, it's more acute, down 2.1%. And for the NASDAQ, more acute still, down 2.9%. As we have the backdrop of this more recent volatility, the backdrop for it is, of course, the debate over AI and whether that trade has gotten overstretched. And so maybe perhaps one of the reasons that the NASDAQ has done a little bit worse. We've also been focusing a lot on what's been going on in the crypto market over that period of time. The 3-day chart here looking a little bit better, but then today, of course, seeing that downturn. And I guess 3 days, really we should be looking at 5 days because Bitcoin trades over the weekend. And by that measure, doesn't look quite as good. Now, I mentioned what's going on in technology. We got to zero in on that today. Here's the NASDAQ 100. And one of the rare areas of green on the screen here you see is AMD, which is up 1.25%. And that's as it signs a new deal with Oracle to provide chips to Oracle's cloud. Now, this perhaps showing that some vendors are looking elsewhere than NVIDIA for more chips, right? NVIDIA shares are down about 4% today, both because of the macro and perhaps because of that pressure from AMD as well. So that's something to continue to watch. But we also see stocks like Broadcom down 4% after it rose yesterday, Tesla down about 3.6%, Amazon down 2.2%. So we're seeing some examples here of some of the high flyers that have now been declining. And let's get to the banks as well, because bank earnings have been coming in stronger than expected this morning, benefiting from a surge in trading and deal making on Wall Street. Now, even though they've been coming in stronger, the stocks are not all higher here. You see quite a mixed picture. JPMorgan right now down 4%. Wells Fargo and BlackRock are up. Citigroup and Goldman Sachs under some pressure. David Hollerith is with us now, our banking reporter here at Yahoo Finance. So David, it's a lot to get through. I know you've had a busy morning. What are some of the thematic things top line that we should know about?
Well, Julie, right as you mentioned off the top, the fact that we've seen just this broad beat across these large banks' Wall Street operations, and that's led to higher revenues compared to a year ago, and just the expectations analysts had going into this is all fairly good as far as the top line goes. But then I would point out that a lot of the conversations in media and analyst calls have focused around the consumer and commercial credit picture. Now, we haven't seen any notable changes or deteriorations from the banks in terms of their credit, but there were a few specific instances in JPMorgan's earnings. They had exposure to the recent bankruptcy. Tricolor, they filed for bankruptcy in early September, and today the CFO, Jeremy Barnum, disclosed they had a $170 million write-down of that loan. And
so they had lent Tricolor money, and then Tricolor ended up going out of business.
Right. So they're now a creditor, and as a from a risk standpoint, they just write down the loan. They might get it back, but for now. And as far as JPMorgan's total credit picture goes, that's not very material. It's not material at all. They didn't have to disclose it. Smaller regional bank, Fifth Third, did. So they did talk a lot about that during the media and analyst call. And Jamie Dimon kind of offered a little bit of a mea culpa about it. He said, he admitted it was not It occurred in the bank's commercial bank division, and he admitted it was not their finest moment, and that they're obviously scouring their credit portfolio for any signs of weakness. But on the consumer side, we actually saw the opposite. The bank has a full year guidance, had a full year guidance of 3.6% for credit card losses, and they reduced that to 3.3% this morning. So that's actually a positive sign. And so we're in this kind of odd situation. Also add to the fact that we have the government shut down. So in some ways, a lot of people are relying on the bank earnings right now for any signs of what's going on. And the bank earnings can only tell us so much about what's happening in their operations.
Yeah, even as big as JPMorgan is. I mean, the other thing we should keep in mind is we're looking at these banks. Many of them their stocks have done very well this year. That's the case with JPMorgan. It's also the case with Goldman Sachs, which has been trading around a record, and Citi, which is up more than 30% this year. So Goldman's an interesting one because it had strong trading revenue, but I guess in some cases not quite as strong as analysts had expected.
Going into this, they beat everything that analysts were expecting. They had a number of specific records in their equity financing, other parts of their markets business. But despite all that, it does seem like the stock has come up a lot, and investors going into earnings, that was a big topic of conversation. There was even a specific note from an analyst, I can't remember who it was, but it specifically highlighting how investment banking, banks specifically, they obviously have a lot more to gain from a deal-making bonanza, which is what we've seen, but it also means they have more to lose if things quickly shut. So anything economically important right now, these banks are going to move on a lot. Right. And the conversation is, are the values stretched or do they still make sense?
Well, we're going to have that conversation right now, Dave. Thank you so much for that. Appreciate it. My next guest says the solid 2025 price performance for banks is justified by rebounding capital markets, lower regulatory burden, and a constructive interest rate environment. Joining me now is Stephen Bigger, Argus Research Director of Financial Services Research. Steve, thanks for being here. As you just heard, we were talking about, kind of the economic backdrop, also the stock action and what we've seen from these banks. Did what you hear from them this morning, by and large, validate your view that the valuations are justified?
Yeah, hi, Julie. I think so. Yeah, this was certainly a banner quarter for the banks so far. We're only one day into the earnings cycle, obviously, but the upsides are pretty considerable. Particularly the capital markets. We expected the lending businesses to be, a little bit weak, kind of this low single-digit loan growth, but capital markets really did shine this quarter, and I think that's, part of the justification for the price performance so far is that those rebounding capital markets, and it's really across the board. IPO activity, it's M&A, it's the trading results, fixed income issuance. So there's really no weakness that we're finding, and the conversations from the banks has been constructive as well. So this is a spooling effect generally. Good results tend to portend more good results because whether it's IPO activity, if a company comes out, goes public and does well, it attracts others into it. And we think there's a fair amount of pent-up demand for companies to go public or even take private. We had some of those like Electronic Arts in the quarter. And keep in mind that the deals, even though M&A deal flow topped $1 trillion in the third quarter, banks don't see that revenue right away. It takes a couple of 3 quarters for those deals to close, for the transaction to take place in order for them to get paid for those deals. So that means, looking out a couple of quarters, we would continue to expect that revenues will still be very healthy.
What do you make of some of these bubbling concerns about credit and about private credit and lending? We just heard Dave talk about JPMorgan disclosing something they didn't need to disclose, but they did perhaps because they know there's some sensitivity around the issue right here. Do you think there are vulnerabilities among the larger banks to some of these loans?
Well, I would look back, even a couple of years. We've been talking about the commercial real estate broadly as being a worry spot for banks, and it hasn't occurred. They've been able to either refinance or some of these loans or get extensions or Interest rates, moving down a little bit has been beneficial for some of these, and that's a kind of a counter to this theme of potentially worsening credit quality. Anytime you have lower rates, it just makes it easier to refinance and a lower payment. So on average, these companies will be able to avoid defaults for the most part. So yeah, I think there's weakness in auto loans and in credit cards, despite now JPMorgan has a stellar credit card portfolio, and they were able to reduce actually their expectations for charge-offs this year. But certainly we're looking at this employment environment getting a little bit more soft. Unemployment hasn't ticked up noticeably. That's one of the biggest factors to look at in terms of higher defaults. If unemployment moves up even a couple of tenths, you will see that in bank charge-offs and thus loss provision. So right now, the commentary from banks is still benign. The consumer's in relatively good shape. Resilient consumer is what they have been referring to for the last several quarters.
So, Stephen, would you say to investors who see JPMorgan and Goldman Sachs going down today that this is an opportunity to pick up some of those shares?
Yes, I think that so expectations were built throughout the quarter that it was going to be a pretty good capital markets quarter. So I think some of that is taking some off the table. I didn't find anything particularly that the banks talked about in terms of guidance so far that was worrisome. Whether you look at the capital markets commentary and how constructive that is, or the commentary about credit quality. Loan growth has been weak, and that's kind of that low single digit, and we don't see that noticeably improving. The Fed rate cut that occurred was too late in the quarter really to have any kind of impact going forward. It could, and future rate cuts may stimulate loan growth a little bit. So that's still out there, but I think the performance narrative that we've had so far this year, the outperformance of banks relative to the market, whether it's a constructive interest rate environment, a little bit steeper yield curve for banks, now some lower interest rates that could benefit the lending growth, this capital markets rebound, which I think is just showing itself to be much more durable, and then this wild card of capital regulation, or just regulation in general, and capital requirements that could be eased a little bit for banks as also a catalyst. So they've got a fair amount of tailwinds here, I think.
Stephen, thanks so much. Appreciate it.
Thank you.
Coming up, trade tensions between the U.S. and China reignite. We're breaking down the latest moves from both nations next. China imposed sanctions on 5 of South Korean shipping companies' U.S. subsidiaries effective immediately. This comes as the U.S. also begins collecting steep fees from Chinese ships coming to the U.S. imposed under Section 301. All of this, the latest moves in the tit-for-tat trade war that sent stocks tumbling Friday and again today. I'm joined by Terry Haynes, Pangea Policy founder, and Nazak Nakhtar, Wiley Rain LLP chair, who served from 2018 to 2021 in the Department of Commerce as Assistant Secretary and Undersecretary. Thank you both for being here. Nazak, let's start with you. I'm curious what you make of this sort of reignition of these tensions that seem to be set off by China imposing these new rare earth mineral export controls. What do you make of that, and what was behind both the move and sort of the timing of the move?
Yeah, very good to be with you. I actually don't see this as a reignition. China last summer started imposing export restrictions on critical supply chains, critical minerals that we need for the production of semiconductors, other types of critical mineral materials. And over the time, it's been expanding its export controls. And remember, we had the Switzerland negotiations in 2025, the London negotiations that President Trump and his team had in 2025 in London to free up some of these exports as China's export controls got bigger and bigger. that expanded to more and more critical minerals and some of the strategic materials we need. And China essentially never let up. It maintained its export controls despite these negotiations. We still weren't getting the feedstock we needed. So I don't see this at all as a Chinese reignition. I actually see this as a continuation of Chinese policies that, one, it instituted just about a year ago, and two, it has been expanding and really never letting up on. With respect to the timing, look, China, what it does, it prepares these measures, and whenever it sees the U.S. sort of taking an advantage, getting an advantage on the global scale, moving with respect to more restrictions on China, China needs to save face. That's very, very big for the Chinese government. Save face. So the U.S. makes a move, whether it's export controls, whether it's the Gaza peace deal, et cetera. China makes a counter move to show the world that China is here, and it is now dominated power, and it is now able to rival the United States.
So, Terry, what does that imply for whether progress gets made between the two?
Well, good morning, Julie. And I think that there won't be progress for a lot of months to come, certainly for the foreseeable future. It's frankly not in either country's interest to have any long-term progress. What you've got here is, picking up on the last point, is you've got the sum of a Trump-Gaza brokered peace that included an awful lot of help interdependence with the major Gulf powers. You've got the U.S.-Argentina bailout. You've got Russia under a lot more pressure from oil to Ukraine attacks. All those things combined are net defeats to China's interests and to its client states' interests, Russia and Iran and the proxies specifically. So, they're not inclined to play nicely with the United States on trade and haven't been for the last 6 months. The markets have talked themselves into the idea that progress is being made, and it's in the United States' interest to continue to have an outstretched hand. But at the same time, neither side is really interested in wanting to move forward here. And among other things, China's reminding us all of that.
I mean, it feels to me like the markets are less concerned with progress than they are about steps back, right? That kind of is the thing that set the market off, that we thought this stuff was at least happening in the background. There was no news. No news is good news. And then you get this post from the president. So, Nazak, where do we go from here? What does this all mean now for these negotiations?
Yeah, I mean, that's the key question. I'm glad you posed that. It's two cool schools of thoughts. One, there's a camp in the administration in Washington, D.C. broadly that believes that negotiations are still possible, right? And there's another camp that said, look, no, look at what we've done. We've been trying to negotiate, and China actually hasn't moved an inch. And so, maybe China's ultimate end game is to not negotiate. And if that's the case, then the U.S. government really has to double down on looking at critical capabilities. China has export restrictions on battery materials and lithium-ion battery technologies, industrial diamonds that we need to make really everything, shipping, as you just talked about, critical minerals, alloys. We know where China has a stranglehold over our supply chains. We've known for this for over 10 years. And yet the U.S. government, across all sort of sections of the U.S. government, has been a little bit slow into figuring out how to really double down and build our domestic capabilities, which includes Congress appropriating money and the administration, the executive branch, moving swiftly to give companies who want to invest in the United States that money. And then again, shield these investments that are now growing in the United States from predatory import competition, China turning around and dumping goods in the United States. This requires a holistic approach. It requires the executive branch to work closely with Congress. And even if we're able to negotiate our way out of this a blip, rest assured, this is China's card. This is the card that China will play over and over again to discipline the United States and the rest of the world. And this time we need to really get our act together and not be vulnerable.
Well, Terry, us not being vulnerable in these negotiations might open up the market to a lot of vulnerability if the U.S. is indeed going to play tough and hold the line. And the market has gambled successfully so far on the so-called taco trade. I know you've got another acronym, but the idea being that we do abandon the harshest tariffs, even if it's at the 11th hour.
Well, sure. The markets are very binary, on sentiment on this in this area. Either everything is more or less going along swimmingly, or there's the prospect of a crisis, and they swing back and forth. They've swung back and forth just in the last 24 hours or so. Yeah, I suggested, I think the taco thing is dumb, because if you suggest 100% and you get 30%, it's, oh, well, he chickened out. Well, he got 30% and applied it. And you haven't paid attention. My acronym was more like BUSAFE. Both usually step away from escalation, and that is part of what's going on here. Both sides judge, and I think China judged first, that for the reasons I mentioned, that it was time to shake things up a little bit, and, as was said, remind people China was here and that they have interests, and that's all well and good. But the administration so far is not interested in backing off. I do think they end up kind of moderating this in the end, but we will go back to this kind of cold trade peace that exists. But if anybody in markets thinks that either side is interested in actually finalizing a negotiation and moving past all this, I think they're dreaming.
Terry,
I want to add that this.
Yeah, please.
I want to add that this tit for tat sort of countermeasure is just not productive. The U.S. government really has to just understand this is a vulnerability, and this is the card China is going to use against the United States over and over again. And instead of wasting so much energy on tit for tat negotiations, really double down and build the capabilities we need at home, so we're not going to be in this position to be in the next time.
Sure, but that takes years, right? So it seems like they're on the path to doing that, but it's not going to be next year or the year after that. It's going to take a while.
You know what? We've made a lot of progress. U.S. industry has made a lot of progress stemming from the work that was initiated in the first Trump administration and carried through to some extent in the Biden administration. We're just a few years away from developing scaled magnet technology in the United States. We've got incredible battery investments in the United States, investments in super hard materials. Those are the industrial diamonds. I would actually say in about 2.5 years, we will be well on our way. So there's a small gap period to solve, but I think the U.S. has been doing a lot better than folks give it credit for.
Nazak, Terry, thanks a lot. Appreciate it.
Thank you.
Coming up next, we're going to bring you today's top analyst calls and our trending tickers. That is next on Market Catalyst.
Welcome back to Yahoo Finance. I'm Brooke Tafama, live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. We're taking a closer look at DoorDash, HP, and T-Mobile. First up, DoorDash. JPMorgan rated the stock overweight, citing the company's recent acquisition of the London-based delivery company Deliveroo. The analyst said over time it expects to see DoorDash bring their operational and logistics playbook to drive more efficiencies into the Deliveroo business. On the street, there are currently 32 buys, 11 holds, and 1 sell rating on DoorDash. Next up, HP. HSBC upgraded the stock to buy from hold. The analyst said the market indicates that PC and printer volumes for HP, well, they may be better than what Wall Street previously had expected. The analyst also said the sunsetting of Windows 10 on October 14th, well, that could provide a catalyst for consumers to upgrade to a new PC. On top of that, she believes that tariff concerns are overdone as HP no longer makes significant imports from China to the U.S. That stock is up today, but is still down more than 10% year to date. Lastly, we have T-Mobile. RBC Capital Markets upgraded the stock to outperform from sector performance. You see that stock moving higher today. The analyst said it expects the company to see strong subscriber growth compared to other wireless peers near term. The analyst also said that thanks to recent promotional activities that T-Mobile had offered, especially around the iPhone launch. Keep it right here on Yahoo Finance. We'll be tracking all the market moves and top calls throughout the session.
Now time for some of today's trending tickers. We are watching Walmart, Albertsons, and Rayonier. First up, Walmart, the retailer announcing a partnership with OpenAI. The deal will allow shoppers to browse and purchase its products on ChatGPT. OpenAI also has deals with Etsy and Shopify to allow ChatGPT users to buy products from their merchants. The OpenAI announcement is part of a broader push by Walmart to incorporate AI into its daily operations. Those shares up nearly 3% in a down market. Next up, Albertsons shares rising after the grocery chain reported better than expected second quarter results. Earnings and sales coming in better than forecast. The company also raised its guidance, helping drive the price action today. Albertsons buyback plans as well. The grocer announced a $750 million accelerated share repurchase agreement, increasing its total buyback authorization to $2.75 billion. And then there's Rayonier. The timber giant agreed to buy PotlatchDeltic. The $3.4 billion deal will create the second largest publicly traded timber and wood products company in North America. It's an all-stock deal. It'll create a company with 4.2 million acres of land across 11 states. The announcement comes on the same day that President Donald Trump's sweeping tariffs on imported lumber and wood products take effect. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, the IMF is out with its global growth forecast for next year. Federal Reserve correspondent Jennifer Schonberger will be live from Washington with the IMF's chief economist to break down those numbers. Stay tuned.
Thank you so much, Julie. I'm joined with Chief Economist of the IMF, Pierre-Olivier Gourinchas, here at the IMF World Bank meetings. Pierre, thanks so much for joining me. It's great to see you.
Thank you. It's great to see you too.
You're out with your new World Economic Outlook, and in that report, you say that growth over the next year is going to be dimmed. How much of that is being driven by tariffs versus other forces? What are those other forces? And if not for tariffs, would we be seeing a more sanguine global outlook?
Yeah, so let me maybe put it in perspective for you and your audience for a second. So back in April, when the tariffs erupted on the scene, and we were scrambling and trying to put our projections together, we projected that there would be a downgrade in global growth. It would be from modest to significant. And so 6 months later, with our new round of projection, we're basically saying, well, the good news is we're at the modest end of the range. So we're projecting growth at 3.2% for this year, 3.1% for next year. And 3.2%, by the way, is the growth rate that we had a year ago for 2025. So you might say, oh, well, then it's unchanged. So does it mean that the tariffs had no effect? And, no. That would be both premature and incorrect. It would be premature because there have been a lot of things that are still going to happen with the tariffs. We're going to talk about some of them, but the effective tariff rate that the U.S. has right now is close to 20%. It's still very high. And incorrect because there have been a number of things that have happened since April that can also help us understand why we're at the modest end of the range. And among those things, I would list the fact that first, the tariffs themselves have been coming down a bit. Many countries have negotiated trade deals, there have been exemptions. So all of these things have kind of lowered the temperature. The second is the private sector has responded. We've had huge amounts of front-loading of imports in the first half of the year, rerouting of supply chains, trying to adapt to this new environment, and that brings some resilience. And third, we're seeing a number of other drivers, not trade-related, that are also helping support the global economy. If you're looking at the US, well, we're in the middle of an AI-related investment surge, and that's certainly propping up activity, investment, consumption activity, all of that is propped up. If you look at other countries, you have fiscal policy that's been playing a role. In China, in Germany, it's going to come and play a role in 2026, even in the US with the budget bill from July. And then, last point, financial conditions. Financial conditions have remained very accommodating in 2025. The dollar is depreciated in the first part of the year. It's stabilized after June, but it's depreciated quite a bit between January and June. And we see equity valuations are very, very high. Credit spreads are very tight. So financial conditions have also helped absorb that shock. So the bottom line is the shock is there. We're feeling its effects. It's going to continue, but it's been offset by other things that have helped keep the global economy buoyant.
speaking of the tariff shock, tensions between the U.S. and China have recently boiled higher. President Trump has threatened ratcheting up tariffs on the world's second largest economy by 100%. He has said that China has become hostile now that they have imposed further export controls on rare earth metals, or rare earth exports, I should say, a sticking point that we thought had been overcome a couple months ago. The president sort of dialing back a little bit of that rhetoric over the weekend, the administration talking with China. But then just this morning, Beijing moving to effectively ban Chinese companies from doing business with U.S. subsidiaries of a South Korean shipbuilding giant. So how is the IMF viewing this? Does this create downside risks to global growth? And if we were to see tariffs ratchet higher to the level of 100%, does that tip the global economy into recession?
Well, it's certainly a stark reminder that we live in a world where this type of trade tensions can erupt anytime. And the trade policy uncertainty associated with that is extremely elevated. And we see that in our measures of policy uncertainty. They remain very, very high, even if we've had some normalization, some trade deals and exemptions. So yes, the picture, this is part of the risks that we're facing. Now, this is something that we are looking at carefully, of course, both the actual developments. The situation is very fluid, so we have no idea where this will land. And I think at this point, the important thing is to think that our baseline, 3.2% this year, 3.1% next year, is the right reference point, if you want. But around that, there is a risk. There is a risk that trade tensions might flare up, and that might materialize. We've tried to assess not the specifics of, the most recent announcements between the U.S. and China, but we've tried to assess what are the broader risks coming from an eruption of trade tensions. So we did a downside scenario in our report where we looked at what would happen if tariffs are increased, if supply chains are dislocated, not the exact assumptions of what might represent the current developments. And the impact on the global economy is significant, 0.3 percentage point, very easily on global output for next year. So instead of saying 3.1%, we could easily be at 2.8%. And so that would be quite a big shock.
So far, the impact of tariffs on rewiring supply chains and inflation has been muted. But in your report, you say that the muted impact from tariffs so far could reflect a delay in higher prices and costs being passed through. So have we yet to really see the full impact of tariffs?
So first, I would separate what we see on the supply chains and what we see on the prices. On the supply chains, we're already seeing quite a bit of rewiring. If you look at the bilateral trade between the U.S. and China, it's down a lot. If you look at the trade between China and other Asian countries or with Europe, it's up a lot. If you look at imports from the U.S. side, much less from China, but much more from Asia, much more from Europe. So these supply chains, they've already started moving. Now, when we look at the prices, what we see is the following. First, the import prices, which is the price at which the exporters are selling when the goods get to the dock, get to U.S. soil. These have not changed. What that means is the exporters, on the whole, are not absorbing the tariff. The tariff is being paid on the U.S. side. It's being paid by the importers on the U.S. side and potentially by the customers when it gets to retail price. We don't see yet a huge increase in retail price. We see some, especially in the very heavily tariffed goods, we see some evidence that these prices start to inch up, but not by a huge amount. So, what that suggests is it's in the middle. The importers are absorbing that in their margins. They're not going to do that forever. So eventually they will start passing that through. And that's what we have in our baseline, that this pass-through of tariffs into retail prices will continue in the U.S. And that's one of the reasons why when we look at U.S. inflation, we're expected to remain elevated. A year ago, we're expecting we would now be at 2%, back at central bank target. We're at 2.7, and we're expecting that it will remain high next year as well.
So when President Trump says that other countries are going to pay for U.S. tariffs, that's not what you're seeing right now when you look at core inflation on goods in the U.S. versus the rest of the world.
As of now, when we're looking at import prices, these import prices have not declined. So this is not being paid by foreign exporters.
I do want to ask you about immigration. we have seen immigration come down markedly in the first half of this year. And in your report, you reference research that if U.S. immigration policies were to remain in place, we could see anywhere from the tune of 0.3 percentage point to 0.7 percentage point impact on GDP to the downside per year. Is that right?
Well, so the impact of immigration here, let me sort of take a step back and think about what it's doing on the labor market. So what we have is a situation where we have much less immigration in terms of the flows, and we're also seeing a decline in the share of foreign-born workers in the labor force in the U.S. And that might be because some of the already here foreign-born workers decide that they are not going to try to report to work, or they actually might move elsewhere. And so that's a significant reduction in labor supply. Now, that reduction in labor supply, it's also a negative supply shock. It's a bit like the tariff. It's reducing the amount that the economy can produce. It's going to put pressure on wages or on prices. So it's something that is, reducing output and increasing inflation pressures. Now, what's been happening right now is that reduction in labor supply has been met by a reduction in labor demand. And so overall, we haven't seen a deterioration in the labor market. Unemployment rate has increased a little bit, but not very much. It's sort of this precarious, that we want to call it, a reduction in labor demand and labor supply, and they kind of match each other. It's a bit of a coincidence, but it turns out to be that way. And that reduction in labor demand is itself coming from the trade policy uncertainty, the normalization of the growth rate for the U.S. economy, which was very strong in 2024, and all of that is basically keeping the labor market in this precarious equilibrium. But where do we go from there? Where we go from there is if you have an economy that has less growth in labor supply, then that's an economy that's not going to be able to produce as much. And so where we can see the impact is when we see the impact on potential growth for the U.S. We have revised down our estimate of potential growth for the U.S. by actually 0.3 percentage points, so from 2.1 to 1.8. And that in large part reflects the lower growth of labor force.
Pierre, unfortunately, we'll have to leave the conversation there. Always so much to talk about with you. We so appreciate your time and insight, as always.
Thank you.
That's Pierre-Olivier Grinches, Chief Economist of the IMF. Julie, I'll send it back to you in New York.
Thanks, Jen. Appreciate it. Coming up, we'll get an analyst perspective on Johnson & Johnson's earnings and planned spin-off of its orthopedic business. That's next on Market Catalysts. Johnson & Johnson looking to get even slimmer 2 years after spinning off its consumer health products into an independent company now called Kenvue. J&J is separating its orthopedics unit. Now, I spoke to Johnson & Johnson CFO Joel Wolk this morning about the spinoff. He said, quote, "We think this business will benefit from focused capital deployment and a focus in the competitive landscape. We think this positions both entities for success. We really like where the portfolio would be after the completion of this separation, and we look to be acquisitive in smart areas." Joining us now, Vamil Divan, Guggenheim Securities Senior Biopharmaceuticals Research Analyst and Managing Director. Thanks for being here. J&J has said it wants to focus on sort of six treatment areas, half in medtech, half in pharmaceuticals. Does it make sense to you that they are planning to spin off this orthopedic business, and is that going to help their focus?
Yeah, I think it does help. I think we've seen them do this over the years. You mentioned the consumer separation. They've also sold other parts of their medtech segment over the years, lower growth areas, trying to focus more on higher growth areas, which were then boosted by the acquisition they did with Shockwave and Abiomed over the last few years. So this sort of ties into that strategy. I think it does make sense and gets them into higher growth areas that they can really hopefully win in. And then the innovative medicine side is doing very well. They've also done acquisitions there to boost that side. That's what's really driving our interest in the stock and our buy rating on the name. But I think both sides are very well positioned now.
Also, when I talked to Joe Wolk this morning, he mentioned the comments from the CEO that this year is setting up to be sort of a catapult year for J&J, that this sets them up for that future growth. Do these results kind of cement that, or what, are you confident in that sort of vision for J&J?
Yeah, I think we are confident in that vision. I don't know. Today's results were fine. I don't think it changes our views too dramatically in either direction. They've been facing some headwinds, specifically on the innovative medicine side, because their biggest product, Stelara, lost patent protection earlier this year, and there's been competition for that product. So that's been something that they've had to work through, but good for them. They are still growing even despite that headwind. But as that sort of fades into the background, then their new product story, especially in innovative medicine, some new launches that they have now, things that we expect to come in the next year to 2 years, should really drive things, or we do expect accelerated growth in 2026, and then even more so as we get into 2027, 2028, and really see this pipeline start to deliver. So yeah, we feel very good about their outlook. The stock's done well this year, and especially in the last few months, we see a lot of room for further upside.
And losing that patent protection on Stelara, this is something a lot of the large drug makers obviously face on a pretty regular basis. And they deal with it with varying degrees of success. Do you think J&J sort of provides a model for what drug makers should be doing on that front? And what do you think has been the things that they have done right that have led them to sort of that optimism about making up for that lost revenue?
Yeah, so we always talk about these businesses are cyclical in some nature. You have these new products that drive growth for a few years, and then they lose patent protection or face competition, and then you go into these periods of decline. I think right now J&J is a great story. They had a couple of years where they struggled for a little bit, but I think they've done a nice job both internally in bringing up new assets and then acquisitions. And it hasn't always been these big, large mega mergers that we all talk about all the time, but they've strategically brought in good assets into areas where they have expertise. So the one product they just got approved last month in bladder cancer is an example of something they picked up a few years back, have developed it now, and now looks like it could be a sort of multi-billion-dollar type opportunity for them. There's a similar product, or different product, but similar story with a product called Icotrokinra, which is for immunology. That will likely get approved next year for use in psoriasis, and then maybe down the road for conditions like Crohn's disease and ulcerative colitis, inflammatory bowel disease conditions. Again, picked up as a relatively small acquisition, and now could be a very big driver for a company of J&J size. So that's what I think we always recommend to our companies. You gotta be good with the internal R&D development, but you also have to look outside because it can't all come from within to be enough for these large mega companies to drive the top line. But J&J's done a nice job over the last few years in building this, and now I think we're going to see the fruits of this over the next couple of years.
We see the shares pulling back a little bit this morning. Not a big decline, a little more than 1%. They have risen quite a bit this year, I think up about 30%. So do you think the pullback is a function of that? They did raise the sales forecast, but they didn't raise their earnings per share forecast. I wonder if there's any disappointment around that.
Yeah, I think you're right. I think that earnings guidance not being raised at all was probably a little bit disappointing, given how well the year has gone for them, given the outlook people have for the second half of the year and in the next year. So I think that's probably what investors really wanted to see. I thought their commentary about the second half was still fine. And again, very positive commentary from them about 2026. So I think that should be fine. But yeah, it's had a big move. I think expectation maybe a little bit looking for a little more than what they delivered today. But once this sort of settles, I think the stock can start growing, running again as we get into the back half of the year and into next year.
Vamil, thank you so much for your perspective. Appreciate it.
Yeah, thank you.
Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst. First up, as stocks fall on renewed trade tensions, we look at the risks facing investors. Plus, with the government shut down for 2 weeks now, we'll look at the sticking points in healthcare, and we'll speak to Pawn Stars Rick Harrison about what the surge in gold prices mean for consumers and the economy. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets. Taking a look at the major averages, we see a little bit of the abatement of selling in the Dow and the S&P in particular. The Dow only down about a little over 30 points right now. The S&P off 0.5%. The Nasdaq continues to lead losses as the sell-off is sharpest in tech. It's down about 1%. Meantime, on the year, the S&P 500 is up a little more than 12%. Several sectors beating the broad index, namely retail. For more on that and to discuss what can keep the market's trend on track, let's bring in Dennis DeBuscher, 22V Research President. Dennis, it's good to see you. I want to get your take first on what we've been seeing in the last few days in the market. You kind of had the discussion ratcheting up about valuations, about the AI trade. Then you had the president's post hitting the market in terms of, this reignition of trade tensions with China. was there sort of a delicate backdrop here when that hit, or do you think it is just that people were discounting the China trade entirely?
So a little bit of both. And by the way, great to see you as well. You mentioned, valuation concerns, the AI bubble that has been a significant amount of conversation over the last 2 to 3 weeks. We had this kind of PE or private equity concern. So it gets to the tricolor event, for lack of a better term, and those private equity firms trading off fairly aggressively. You saw the banks underperforming. So yes, you had a little bit more of a fragile backdrop where no one thought that the re-escalation of China tariffs or trade risk was going to happen at a time where you had a lot of AI bubble-related concerns and some potential contagion concerns related to lower-end consumer bankruptcies, things like that.
And so where does all of that leave us now, Dennis, in terms of, on the valuation side, has the sell-off over the past few days taken enough wind out of the sails that it's time to get back in there and buy the dip?
Yeah, well, I wouldn't say the sell-off has made it overly attractive, but we also pushed back pretty hard against the idea that we were in a bubble from an aggregate point of view. So when you look at the S&P and you look at the implied cash return yield on a forward basis relative to history, the market wasn't cheap. I'm not going to say that, but it was certainly not way overvalued at all. So from a macro point of view, to the extent that we believe that the cycle is going to continue, and that's our call, leaving the shock out of it for a second, you should be buying declines in the market. Now, there is the potential for very specific bubbles within the market, which I wouldn't extrapolate to, say, the S&P. The GS, the Goldman Sachs retail basket was up 20% month on month. 3 names in there, particularly the quantum computing names, were somewhere up almost 300%. I'm not going to say it's a bubble because I don't know those names in particular, but that's certainly odd behavior. So there's areas of the market that are due for a pullback. It doesn't mean we're in an aggregate AI-related or market-related bubble. So we're inclined to buy dips. I would just be careful with some of the stuff that's really moved aggressively recently.
Gotcha. So there might be mini bubbles, but not necessarily
Yes.
a bigger bubble, Dennis. So if you are then looking in the market and figuring out where you want to buy the dips, is it within that broader AI space?
Yeah, so I think until proven otherwise, you do want to be investing in the broader AI space. Again, maybe not chasing a name that went up 300%, but yes, it seems like the AI CapEx is, very likely to be spent over the course of 2026 and into 2027. No real reason for that not to continue. Again, I'm assuming that there's some de-escalation on the China side. So the short answer to your question is yes.
And I also find it fascinating that you, like many investors, you say go long the AI trade where the fundamentals are warranted, and also go long gold. And that's obviously what we've been seeing happen, right, unfold this year. Why does your team think gold is still also a place to be?
Well, gold benefits from the fact that treasuries right now are not diversifying in a portfolio. So the correlation between bond yields and stocks has flipped. Term premium in bonds, not to get too technical, are increasing, and that has a lot to do with the deficit. So alternative assets that are more diversifying should benefit. Now, that would favor gold over a cycle. So over the cycle, there's a case to be made for things that would, say, fill the role of bonds like we saw in the post-global financial crisis cycle. Now, one thing that is a little bit concerning from gold that we did mention is that it's more highly correlated to momentum. So the momentum factor and gold have become more highly correlated. That makes us a little bit worried because it's now moving from a diversifying asset to something that's just more beta driven. So there is some potential for some pullbacks, but over the cycle, it would be more inclined to be owners of gold than not.
And then finally, Dennis, also another thing that you flag in a recent note, and this is appropriate on a day when we're starting to get the big banks reporting. You mentioned Tricolor, also that exposure from JPMorgan. You say to long banks and short private equity. And what makes you say that, and why at this moment as well?
Well, that has a lot to do with the fact that we think that the banks have been much more, let's say, forced into a higher quality loan backdrop over the last 10 years. And everything we've heard from the banks, which was reinforced today, by the way, is that consumer loan lending is holding up okay, consumer spending is holding up okay. So, and this has been well flagged by the banks for a very long period of time. So we found it hard to believe that based on some of the things that seem more specific to private equity and some of the things that they're invested in was extrapolated to a contagion risk of banks, which have underperformed. So that's why we like that trade, and we expect that to continue.
Dennis, great to see you. Thanks a lot for joining us.
Great to be here.
We got much more markets action coming up. Stay tuned. You're watching Market Catalysts. Government shutdown dragging on with Affordable Care Act subsidies, or premium tax credits, PTCs as they're called, continuing to be a major sticking point between Democrats and Republicans. Joining me now, Chris Meekins, Raymond James Managing Director, Washington Health Policy Research Analyst. Chris, it's always great to get your perspective on this stuff. And we're all trying to figure out what's going to happen here. And if there are these areas of commonality, it does seem like some Republicans are willing at some point to extend these subsidies, but it's not happening now. So what do you think happens next?
Yeah, I think it's a great question. I think it's important to keep in mind the expanded child tax credit during COVID. And during the expanded child tax credit during COVID, you had Republicans and Democrats who agreed they needed to continue it. You know, the child tax credit went for $2,400 up to $3,000. And they were sending it to people in 12 monthly installments to your bank accounts, giving everyone who had a kid that was income eligible $250 a month. People said, there's no way you're ever going to take it away from people. And what ended up happening was it ended and it stopped. It was a temporary COVID benefit, despite both parties wanting to see it get across the finish line. Here, what you have is a large group of Republicans who have said they do not support extending the enhanced premium tax credits or the subsidies for the Affordable Care Act plans. But you do have some small number of senators and House members on the Republican side who are open to having a conversation and negotiating with Democrats. The challenge here is they're not even talking about negotiating. Republicans' position is, until the government's reopened, we're not talking, which isn't inconsistent because that was the Democrats' position during the 4 previous shutdowns that were caused by Republicans.
So, Chris, usually these things end when the political pressure on one side or the other becomes too hot, right? That someone gets blamed for it. Are we there? Are we close to there? I mean, what's public sentiment like in this case?
The public seems to largely not realize we're in a government shutdown, unless you're an employee who's missing your paycheck, which in DC, obviously, there are a good number of those. And if you were a member of the military and were going to miss a paycheck, that would be a problem. But President Trump has found creative, I guess we'll call them, potentially legal ways to pay them. And so they're going to still get paid. So there doesn't seem to be this catalyst. Both parties think they're in the right here. Republicans say, look, you never gave us anything when we said we had to have X to reopen the government during CRs, you know, from the 90s throughout the early 2000s. And Democrats think that their base is happy with them for just fighting the Republicans over something. And there doesn't seem to be this motivation, which is why we might be here for a while.
What's going to tip the scales? I mean, again, to look at past situations when planes stop flying because there aren't enough staff at airports, whether it's FAA or TSA, you know, when people's lives beyond those who are not getting paychecks start being affected, we're starting to see some disruption to flying, right? But where else are we seeing it, and how big does it have to get?
Yeah, I think there will be a point where, one, if you have a huge number of flights canceled, that would obviously be a wake-up call, and some members of Congress may feel the need to negotiate. But really what it might end up being is the current CR that the House passed runs to November 20th. If we start to get close to that day, then they need to do something regardless. And maybe they kick this around. But that is obviously another month away. And there's a lot of time between now and then. But if you look at the Trump administration, they're not slowing down. Since you've had this government shutdown. You've had one or two pharma deals that have been announced to lower drug prices. You've got the hugely consequential hostage agreement and ceasefire in Gaza and Israel. They're not slowing down. They're still doing the work. And Democrats still have their base happy with them for fighting at this point.
And do you think that this could be poised to be a record shutdown in terms of the length?
Nothing makes me think it's going to get done soon. So all signs point to this potentially being a record duration shutdown at this point.
And Chris, obviously the market doesn't much care about the shutdown either. So that's not something that's going to force the administration's hand. But some of the other things that you mentioned that they have been working on have affected the market. The drug pricing deals are one of them. I thought it was interesting today we got an earnings report from Johnson & Johnson, but when I asked CFO Joe Wolk about any kind of drug pricing agreement for them following on Pfizer's and AstraZeneca's, he said, we're having lots of great dialogue with the administration. He seemed pretty confident. So is this the template and we're going to see it for all the other drug makers?
I think we are going to see more drug makers follow suit. I think one of the things some drug makers are waiting for is to see what the Inflation Reduction Act Medicare negotiated rates are. We'll get those in November for 15 additional drugs. Obviously, Ozempic is one of the biggest that's on the list, but other companies have them, GSK among others. And so I think part of it is waiting to see what those numbers are, which then allows them to do the math calculation. But when you peel back what these agreements actually do, if Trump's first term, it was Operation Warp Speed, this is more like Operation Warp Talk. There's big, bold ideas, but not a lot of substance there at this point. And when you look at whether it's, MFN, one, we don't even know that they're getting the best price of any other country. They haven't disclosed what the price is that Medicaid's going to receive. We know that companies that agree to launch prices at the same price in Europe and the US, that just means probably that the launch prices in the US are going to go up because Europe will inevitably delay launch over there because they won't want to pay the US prices at this point. And the tariff issue, they're agreeing to invest manufacturing in the US, which some were already doing anyway, but they get to avoid the tariffs as a result of that. So when we peel back the onion, yes, some governments may save some money, but the average taxpayer probably isn't going to.
Chris, thanks so much. It's always good to see you. Appreciate it.
Thank you.
Well, Health Savings Account Administrator Health Equity is launching 2 new platforms to expand access to affordable health care, including a GLP-1 program with a licensed telehealth provider and a direct enrollment platform for its health savings accounts. Joining me now is Scott Cutler. He's Health Equity President and CEO. Scott, it's great to see you. So let's walk through these, I guess, one by one. We have seen a lot of efforts to expand GLP-1 access. What's your particular spin on it there at Health Equity?
Well, taking a step back, HSAs for all Americans is a savings vehicle that enables you to save, spend, and invest for healthcare. And at Health Equity, we view our role as to empower healthcare consumers, give them opportunities to have access to affordable healthcare solutions. Weight loss management has been a very popular program for many Americans that are looking for, again, programs to be able to help with their weight management needs. And using your HSA is a tax-advantaged way to be able to pay for access to those programs. And so what we've announced today is effectively the integration of a telehealth solution to give you access to a licensed physician to be able to use those tax-advantaged dollars to spend towards a program like weight loss management.
A lot of the drug makers themselves are also offering, direct plans where people can get discounted, these discounted GLP-1 medications. Can that work in tandem with what you're talking about? So they both get that discounted rate and they can use those HSA dollars?
Yeah, so it's both. So going through the process on our platform, you have access to a licensed telehealth provider to be able to have a consultation with a licensed physician, and then ultimately, should that result in a prescription, you have the choice in terms of the prescription that you would like to be able to go on at very attractive pricing. But that pricing, it also can be empowered by the use of an HSA dollar, because think of it as saving 30 to 40% on a pre-tax basis to be able to pay for that product. So today, last year alone, $44 billion was spent in HSA accounts for things like copays, for things like prescriptions, deductibles, and now we're effectively bringing those solutions into the platform to be able to have an integrated way right within the Health Equity app to give access to those programs, again, with those tax advantage dollars.
And you're also doing this direct enrollment, which is part of what you're describing, right? So how is that a change for you guys?
So direct enrollment is really largely to address legislative change that happened over the summer that expanded access to about 7 million Americans that currently today have bronze plans that are now newly eligible to be able to have an HSA. And so we wanted to provide a more seamless app-based way, secure and trusted, for that onboarding experience for these new market participants that now have access to an HSA for the first time. And so think of it as an easy way to enroll, an easy way to set up an account, an easy way to fund the account, and then for us to be able to provide the education on how should I use this account for my healthcare needs.
And how are you thinking about the overall healthcare affordability problem there at Health Equity, Scott, and sort of tackling it in these various ways?
So this is a big problem for America. I think 44% of Americans can't afford their healthcare costs. Healthcare costs are rising 3 times that of wages. And for many employers, healthcare costs this year are expected to rise 9%. That's more than any time in the last 15 years. So it's a problem overall. And so we're looking at how is it that we can create solutions to be able to address this affordability crisis. And HSAs is one private market solution, but you think about that solution to be able to empower Americans to save and then to invest for their healthcare needs. And so I think these solutions are really important at a time where healthcare is a crisis in America.
Scott, are you seeing any changes in HSA elections? In other words, how much people are putting in their health savings accounts? And does that change based on how comfortable people are feeling with their economic situation?
So as an industry, there's about 40 million accounts and $150 billion of assets. So many people already have these types of accounts. But I think what's really important is if you have the opportunity first to select between a high deductible health plan or another, you ought to really think about a plan that qualifies for an HSA. For the millions that have HSAs, it turns out that only 4% are contributing up to the max that they're allowed under the regulations. So you should be contributing at the max. And then you should also be thinking about how is it I can prepare for the future, and so then become an investor in this type of account. And so I think the opportunity in the HSA industry overall is to drive awareness of adoption, and then drive awareness of the power that your contribution can have. And then ultimately, as we create more opportunities to be able to spend those dollars wisely, to be able to handle the challenges that many people are having in terms of access to affordable healthcare solutions, but then how to grow and prepare an account over time to address your future healthcare needs. This is what this product was created for.
Scott, good to see you. Thanks so much.
Thank you.
We got much more market action coming up. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke DePalma, live at the NASDAQ here in Times Square. Let's get a quick check on the latest market action because we're about 2 hours into today's trading session. We're seeing all 3 major indices move into the red. If you could see across the heat map on the YF Interactive, we do have the biggest laggards, NVIDIA, moving lower this morning, down about 3.5%. After over the past 10 days, we have seen some downward pressure after that sell-off on Friday, then some momentum return on Monday. Now we're seeing that sell-off continue revenue down once again more than 3.5%, down about 2.6% over the past 10 days. Also want to take a look at Broadcom because that stock is pulling back some of the big gains that it posted on Monday following the announcement that the chip giant made a deal with ChatGPT with OpenAI. That stock is up about 4% over the last 10 days, but once again, we are seeing a bit of a pullback today, down about 3.5%. Now, another company that also made a deal with OpenAI, a partnership rather, was Walmart, and we are seeing that company pop a bit, up nearly 3% 2 hours into today's trading session after once again they announced that they plan to use and partner with ChatGPT in order to create a change within their search function, calling it more of a conversation. Of course, this comes on the heels of multiple deals announced or multiple partnerships announced with OpenAI over the last few days alone, including with AMD. That stock seeing some momentum this morning, up about 1.3% as well. OpenAI also announced partnerships with NVIDIA and Broadcom, but those stocks once again lower. Tesla also moving lower today, down about 2.75%. That's after we saw the company return to, or rather the stock return to see some momentum year to date. It is now up nearly 5% after gaining for the first time since the start of the year. We'll keep a close eye on that, especially as it's down nearly 3%. But taking a look at sectors, we are seeing some rotation within investors right now. Moving the most, we do have some movement into industrials. That sector up about 0.5% 2 hours into the trading session today. Also some rotation into consumer staples. We typically see this happen when investors see some volatility within the markets and they're seeking out safe havens. And then we also have the tech sector. That stock down, or that sector rather, down more than 1% after such a run up this year, up more than 20%. We're seeing this bit of a flip, a reversal today as investors really seek out some safe havens within this market. Taking a look at all three major indices, all still in the red as of now. The Dow bordering the flat line here, down about 0.1%, with the downward momentum really coming from the Nasdaq, down about 1%, and the S&P 500 down about 0.5% 2 hours into today's trading session. Keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout the session.
Now time for some of today's trending tickers. We are watching BlackRock, Meta, and Domino's. First up is BlackRock, the world's largest fund manager, out with its earnings. Joining us for more, Yahoo Finance's Ali Canal, and they manage more now than they did the quarter before.
Yes, pretty solid quarter here for BlackRock. Now, shares did hit a record high earlier this morning. We are off of those highs, only up around 1% at this point. Now, the firm brought in $205 billion in net inflows. That was led by a record demand for iShare ETFs and continued strength in private markets. CEO Larry Fink called it, quote, unlike anything we've ever seen heading into what's traditionally their strongest quarter. Now, analysts saying that the beat came from higher performance fees, which helped offset costs from investments in private credit and infrastructure. So those are basically plays for BlackRock to broaden its reach beyond just stocks and bonds. And we're hearing that more and more when it comes to different types of opportunities for investors. And related to that, BlackRock has really been doubling down on crypto exposure. We've seen Bitcoin ETFs, Ethereum ETFs, and Larry Fink did specifically talk about this and highlighted those ETFs as key contributors to fee growth this quarter. Year to date, BlackRock shares are up around 13%. We've seen the financial sector in general do well within this environment, and there should be more catalysts ahead with deregulation, continued easing from the Federal Reserve as well.
Right, although there's still some concerns around that private credit and private equity valuations as well. So we'll see how all that plays out. Let's talk about Meta. Also, it's announcing changes to Instagram for users under the age of 18. Now, Meta's been under pressure for a long time, particularly from parents around these kinds of parameters. And so it's finally coming out with something.
Yeah, it seems like that this is part of that ongoing effort. We know whenever Meta CEO Mark Zuckerberg is on Capitol Hill, he always gets these questions from lawmakers as well. And part of this is going to restrict content for users that are under 18. So it's going to be automatic. The only way you can opt out of it is if your parents specifically go in and allow for those settings. And AI is going to block posts with strong language, risky key stunts, drug references, and Meta says it's aligning these policies to what parents already really say is their top concern and what they already understand when it comes to some of these standards. But the timing is notable here. Meta's been under pressure, as you said, Julie. The company is still facing lawsuits alleging that its apps are harmful to some of those younger users. And it does follow earlier steps from Meta to limit live streaming for users under the age of 16 and cut off accounts with explicit content or adult-leaning content. We'll see, though, if this creates any real change.
Yeah. Finally, let's talk Domino's. The pizza chain posting better than expected quarterly earnings and strong U.S. sales. The shares are up 3.5%.
Yeah, surprising beat here. Earnings, U.S. same-store sales, both topped estimates, up 5.2% last quarter. And that was thanks to a few different initiatives, one being the best deal ever promotion, another stuffed crust pizza, and a new partnership with DoorDash. And despite the pop in today's share price, we do have a stock that's essentially flat year to date. Now, investors have worried about softer demand across the restaurant space, especially among lower income consumers, plus the broader pullback that we've seen tied to weight loss drugs and really macro uncertainty with inflation still pressuring that everyday consumer. But management does say that momentum with those strong same-store sales numbers should hold into 2026, and that's expected to be powered by loyalty rewards, delivery expansion, and new menu items. And we've consistently seen that with these fast casual chains, it's all about innovation, maintaining that loyalty, and having some sort of value that you can present to the consumer.
Well, I guess it's working for the moment. Yeah. All right. As always, thanks, Allie. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. We got more markets action coming, including some of the challenges for the housing market. We'll be right back. The housing market remains sluggish as homebuyer competition slumps to a 6-year low in September, according to Redfin, with the number of home buyers canceling deals hitting a record rate. Joining me now in the State of Housing, Daryl Fairweather, Redfin chief economist, and here's a special treat. She's in studio with us. Usually she is remote, so it's good to see you in person.
It's great to see you too.
Although we're not talking about great numbers, to be fair. That cancellation rate is really interesting. So that's basically when somebody signs a letter of intent, they're going to buy the house, and then they say, never mind. So what's the rate right now, and what's contributing to that?
Well, cancellations have been going up. It reached a record high for this time of year, and it's really because home buyers and home sellers are not seeing eye to eye. Home buyers, they're facing these really high interest rates. They feel like it's not affordable to them. But home sellers have record low mortgage rates that they got during the pandemic, and they need an incentive to move. So when something goes wrong during escrow, like something comes up in the inspection and there needs to be some kind of payment to make things whole, buyers expect money, sellers don't want to pay, and the deal just tends to fall apart.
So that's interesting. They're looking for that as a negotiation point, and it's not always working. Sometimes I guess it works, but frequently I guess it doesn't, which is really interesting here. And then what about the competition figure? What is that reflecting?
Well, the sale to list ratio is falling, which means that more homes are selling for below their asking price, which is an indication that buyers are able to make offers successfully that are below the asking price. That usually only happens when they're the only buyer that's interested in the home. And sellers, if they don't have an offer from anybody else, they don't really have anything to negotiate with, so they have to lower their price in order to get the home sold.
And we are in the fall season. What does that backdrop typically look like for the housing market?
The housing market tends to get really active in the spring and summer and falls when things start to cool down. It's back to school season. People are busy with other things. The holidays are coming up. So it's not usually when we see a lot of home buying activity. Mortgage rates have come down, which we thought might bring some home buyers back, but it's actually brought more home sellers to the table, which is a good indication that prices could moderate, because if there are more home sellers relative to home buyers, that means that buyers have more negotiating power and prices will likely fall.
But they're not falling yet, right? We are still seeing that upward trajectory for prices, and is that one of the other kind of sticking points for all of this?
Home prices have been increasing, but they're increasing slower than the rate of inflation. So in real terms, the values are starting to erode. I think this is an indication, though, that when mortgage rates fall, we probably won't see much of an acceleration in prices. Usually when mortgage rates fall, a bunch of buyers come back, there's competition, prices go up. But because home sellers have also been held back by mortgage rates, we think there'll be more sellers and more buyers, and that could keep prices more stable even as mortgage rates fall.
Interesting. What about regionally? Are you seeing any places that are outliers from some of these overall trends?
Absolutely. The Midwest is a place where home values are increasing, which is pretty unusual historically. These Rust Belt cities, they used to be in decline pre-pandemic, but now we're starting to see their economies grow, incomes going up, and homes are still affordable there, at least relative to the national figure. You can still afford a home, say in Cleveland, on the median income, and that means that there are still buyers interested in buying, but there wasn't a lot of supply built during the pandemic in the Midwest. So this increased demand is coming up against limited supply, which is why prices are going up there.
Are we seeing a shift in regional, like where things are affordable? Like for a long, you get sort of those longer term trends of like the most affordable cities to live, but are we seeing a remaking of that at all during this latest period?
Well, the places that are getting more affordable are the places that have built a lot of housing. Think Texas and Florida. Texas is a place where home prices are falling because there was a lot of new inventory that came online. The new construction has slowed down, so I'm not sure how sustainable that will be because you need to keep building in order to keep prices affordable. But for now, you can get a deal there, especially if you're in the market for a condo. That's where we're seeing buyers having the most power and the most ability to negotiate down prices.
Really interesting. Daryl, thanks so much for coming in. It's great to see you.
Thank you for having me.
Thanks. Coming up, as gold prices soar, we're talking with longtime Las Vegas pawn shop owner Rick Harrison from Pawn Stars about precious metal demand. Stay tuned. Precious metal prices have soared in 2025, with gold rising over 50% year to date, silver up 70%. Gold's on pace, in fact, for its best year since 1979. And while many are buying and holding on to their gold, for a look at what it means for pawn shop owners, I want to bring in Rick Harrison, who you may recognize from the TV series Pawn Stars. He's also the owner of the Gold and Silver Pawn Shop in Las Vegas. Rick, it's good to see you. Thanks for joining us.
Thanks for having me.
So we've seen prices go up. Does that mean like a huge influx of traffic into your store with people who want to know what they have, how much it's worth?
I am buying a little bit more gold, but it's hurting on the retail side. When people come in and they go to, they get serious sticker shock when they start looking at jewelry. 14 karat gold, it scraps for like $75 a gram right now. So, when you come in to buy, retail, buy a ring for, a little 5 gram wedding band, and it's like $700 retail. I mean, it's, people are a little shocked.
And so that implies to me that you, in other words, you're not eating the cost, right? You're hanging on to your margins and you're raising your prices with the price of the underlying metal.
Yes. Even if I bought it, I bought something a year ago, I'm not going to, I'm definitely going to sell it for more than I did last year, because if I sell it for what I had priced last year, I could actually just put a torch to it and sell it for scrap and get more.
So, so what kinds of changes then are people making? Like, if they're coming in and they're getting that sticker shock, is there any jewelry that is more reasonable that they're pivoting to right now? How's that playing out?
A lot more people are buying like silver jewelry, things like that. I don't see a stop in the prices going up either. There's a massive deficit in the amount of silver we have in the market right now. There's no silver mines left. All silver production, it's ancillary from copper mines and gold mines. So I think there was a 150 million ounce deficit last year when it came to silver. So that price is going to, just supply and demand, that's going to go up. And central banks are buying gold like crazy. So you have any tips for people out there who have jewelry at home that they're thinking about selling? Do you think they should hang on to it? Do you think they should get it assessed? What do you think? I think they ought to hold on to it for now. I do not see a stop in the price going up. India broke a record last month on the amount of gold imports and silver imports. China's buying gold, tons of gold every year. Central banks around the world are getting rid of U.S. bonds, and it's the whole de-dollarization thing, and they're buying gold. So I just don't see. I see it going up for a while.
Rick, I want to ask you too just about the underlying business, right? You being in Vegas, big tourist destination. Have you seen decreases in traffic? Are fewer people coming to Vegas and coming into your store?
Actually, the last month has been really, really good. I mean, the actual amount of people coming in the store has gone up. I do know the actual number of people coming into Vegas has gone down a little bit. But I think it's a cyclical thing. I've said this before. I think, we're kind of suffering from a COVID hangover. Everybody during COVID got so much money and they were spending that money. And when the mask came off, everybody went on vacation. And I think it's just slowed down a little bit because of that, but it'll be back. And I think the hotels on the Strip have got the message that, stop charging so much to have money. And I think they're listening a lot.
And what about pawn shops as an economic indicator, right? I think about on both sides. Obviously, there's the retail business that you talked about, but there's also people coming in because they need to raise cash, right? So, what are you seeing on that front lately? And are you seeing that kind of as a sign of stress or not in the economy?
That I see holding kind of steady right now. So I don't see an uptick in people wanting to come in, more people getting money. So I think the economy's kind of flat at the moment, and everyone's still kind of a wait and see attitude, but I don't see the economy down at the moment as far as in that respect.
Are you seeing any kind of change in stuff that's moving in the store?
I will tell you that every time I get gold bullion and silver bullion, we'll get a shipment in the morning, and it's gone by 2 or 3 o'clock. Wow. Literally, we cannot keep any of it in stock.
And what about collectibles, for example?
Collectibles, that's a weird market. If the price of one if one group of collectibles really goes up in price, it usually affects another group of collectibles that'll go down. Pokemon cards are kind of flat, but they're still bringing money. Disney stuff over the past couple of years has really gone down. It's hard to sell Disney stuff, and I think that's because some of the moves Disney has done. But generally, coins have gone really up. A lot of people are, buying coin collectors. They've always been around, and yeah, in general, the market's pretty, decent and hasn't. I don't see any giant jumps in anything here lately. Like I said, the only thing I've seen go down in price over the past couple of years is Disney stuff.
Interesting. All right, Rick, thank you so much for joining us. Appreciate it.
All right, thank you. Have a good one.
You too. Let's take a look at the markets before we leave you here as we see stocks selling off, except for the Dow, which has now turned positive. That may be in part due to the financials. That's the best performing group in the S&P 500. But all across the board here, we are seeing definitely stocks bounce off of the lows as we head into midday. That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We got more Yahoo Finance coming up.